We'll continue with our session. Question number 5. Question number 5 reads, which of the following are indirect instruments of the monetary policy? Which of the following are indirect instruments of the monetary policy? So we looked at the categories of instruments that the central bank will use, being direct and indirect. So the indirect instruments, we said influence the money supply and the credit conditions via market mechanisms rather than the direct. So we also mentioned that the required reserve ratio, the RRR, is a form of indirect because it affects the lending capacity of banks, influencing credit availability, liquidity. So we also looked at the sectoral loan restrictions. These fall under direct instruments because the central bank will dictate where these monies will go. It will target certain areas. All right, so today we'll proceed with question number 6 upwards. Um, 6 upwards. So question number 6 reads as follows. Which of the following is a step that the central bank will take to encourage greater investment in the economy? You look at the increase in cash reserve ratio, reduce the cash reserve ratio, increase the bank rate. You look at selling securities to the open market. So we must understand that government uses many ways to control the economy. There's what we call the fiscal policy and the monetary policy. The monetary policy is a means through which the central bank uses the government uses central bank to control the economy. So there are several steps that the central bank can take to encourage uh, greater investment. So the Bank of Zambia uses one of the tools like the reserve ratio, and the reserve ratio, like I mentioned, is simply a minimum balance that commercial banks must have. So the cash reserve ratio is a portion that commercial banks should deposit with the central bank. So this money is what cannot be lent out to customers. So meaning they are non-interest earning for the commercial banks. So by adjusting this reserve ratio, the central bank will use this mechanism to control the flow of funds and may impact the economy at large. So steps that the central bank may use to encourage investment will be reducing the minimum balance, which is the reserve ratio. So if the government limits um, if the minimum balance, which the reserve ratio is here, so meaning this amount will be tied, it cannot be lent out. So the way the government will do is simply to reduce a reserve ratio here, meaning to free up this chunk of amount of money to become loanable or to be performing in the economy. So by reducing the reserve ratio, the Bank of Zambia will allow commercial banks to hold a smaller portion of their deposits as monetary reserves. So this will free up more funds that can lend to businesses and households. So the effect that this may have on supply is that one, there will be lower interest rates and increased availability of credit. So businesses can borrow to invest in projects for expansion. Then the um, context in Zambia, if Bank of Zambia will reduce the reserve ratio from, for instance, from 10% to 7%, what it means is that with 100 million in deposit, they will only allow 7 million with the Bank of Zambia instead of 10 million. So the remaining 3 million will be available for lending, like I illustrated in this. Okay. So if we're going to um, look at our multiple choice questions, who dominate on the answer to do with reducing the reserve ratio. So which of the following steps will encourage greater investment? With that being said, B, you look at reducing the cash reserve ratio. Then name the three C's of credit that exist. The three C's of credit that exist. You know the three C's that exist of credit? We have what is called character, capacity, and capital. These are the three C's that are talked about when it comes to the three C's when it comes to credit. Character, which is defined to be the borrower's integrity or willingness to repay a loan. So a bank can evaluate credit history of previous loan repayments to see their reputation. So CRB does that. Capacity, referring to the ability to repay that loan. So this assessment can be examined using the statements. Then lastly, capital, which looks at the what the person owns. Okay, what the person owns. So these are the three C's by definition. So when you go to the question here, what are the three C's we're looking at? Character, capital, charity, no. Character, opposite charity, no. So which one is it? D, right?
So that would be D, yeah.
Yes. Then identify the formula for the capital adequacy ratio. The formula for the capital adequacy ratio. Now, for us to understand the formula, first we must understand what is this CAR really in its context. So CAR is actually an uh, a measure that the bank uses to see whether there is sufficient capital to absorb the potential losses and maintain solvency. So we have the formula given as follows: Tier 1 as Tier 2 capital over the weighted assets. So when the Bank of Zambia wants to ensure people are not duped, they have to calculate this, like it happened with the Intermarket Bank. So Tier 1 capital is looking at the equity of capital and disclosed reserves. So it provides a buffer for unexpected losses. For instance, Zanaco PLC paid up share capital and retained earnings. Then Tier 2 capital is some supplementary capital. It includes revaluation reserves, hybrid instruments, and undisclosed reserves. So here, this one is used to absorb losses after Tier 1 capital has been depleted. Then the risk-weighted assets, these are all the assets that the bank may have according to their risk level. They may include personal loans and government bonds. So Tier 1 plus Tier 2 divided by the weighted assets. So this is what makes what we call the capital adequacy ratio. Tier 1 plus Tier 2 capital over the what? The weighted assets. So if we go to our question here, which one denotes the formula for the CAR? Tier 1 plus Tier 2 over risk assets over Tier 1 plus risk assets. So the answer there clearly is A, isn't it? Okay,
Yes, it's A. Mm.
so we go to question number um, 9. What is the total output payout an individual's investment of 10,000 at 5% in 5 years? So here we're simply calculating what? We're calculating the future value. Future value is equal to present value 1 plus r to the power time. So what is our present value? 10,000. Our interest rate is 5%. The time duration is what? 10, 5 years. So when you calculate that, this is straightforward. We're going to have what? Computation as follows. Future value is equal to what? Present value. 1 plus R to the power time. Present value here is what? 10,000. Then interest rate is 5%, so 1.05. The power 5. What do you get when you calculate that? Are you getting 12,
And
8,
this time.
84? What are you getting? 12, 7,
Hello?
63. Are you calculating?
1.05 to the power. Yeah. Just give me a minute. 1.28276. Yeah. Let's go it. 1.276 times 10 is 10,000.
Mhm.
It's 1.2. Okay. 1.276 times 10,000.
Okay, so
Yeah. Total 12,760.
so the nearest is the lowest here. There's no exact answer here, but the nearest is this one here. Okay, so
Wow.
yeah,
Okay.
what is the risk weight for personal loans? What is the risk weight for personal loans? So here we are we together so far?
Yes.
We're not lost. We are all on the same page.
Mhm. We're on the same page.
Okay, so let's go to question um question number 10. So what is the risk weight for personal loans? So risk weight, what is it? It is a percentage that is assigned to different types of assets that are held by banks to determine the amount of capital that must be held under the capital adequacy reserve ratio. So it is just there to measure the potential credit risk exposure that is associated with various loans or investment. So why are personal loans 100% risk weighted? One, first you need to understand that personal risk loans should always be weighted at 100%. So the answer is what? C. But the reason is simply that personal loans are generally unsecured or they're partially secured, so it makes them fully exposed to default, unlike government securities, which are risk-free. Secondary, or point number two is that it's a regulatory requirement. So when you're calculating the CAR calculations, banks must allocate the capital equivalent to 100% of the risk weight to a personal loan exposure. For instance, if a bank lends 1 million in personal loans with 100% risk weight, a full 100 million counts towards the risk weight. So you don't lose your money. If a bank goes into solvency, your money must be given to you no matter what. So you must understand that the structure, according to regulation, for the risk weight that is associated is as follows. Number one, bonds don't have this that's what they called risk-free rate. The treasury bills have zero. The corporate bonds they range between 50 to 100. Personal loans have 100% risk, and mortgage loans they range between 50 to 75. So this is usually the norm. So the high risk weights are usually allocated for personal loans to discourage banks from overexposure to high credit. So they'll maintain stability with in Zambia. All right, so that's our answer. Question number
Okay.
11. A business that gathers credit information on all borrowers in a particular region for purpose of selling that information is called an or a. So The answer is a credit bureau. What is a credit bureau? It's a specialized company that will collect and analyze and will sell information about you and I, businesses, factories, financial institutions. So their goal is to reduce what is called information asymmetry and to also improve the lending decisions. So credit bureaus are there for many functions. What do you think is the function of a credit bureau? You heard of a credit bureau?
Is it like CRB?
Okay. Um,
Huh?
a credit bureau. What do you usually do at the credit bureau? So, what credit bureau is also called a credit reference agency. So these ones, their role is to collect and analyze and distribute information about individuals. So their functions are to collect information on credit, they'll gather information, they'll maintain credit records. So they'll maintain a centralized, updated record of the borrowers. They'll assess the credit worthiness. Yes, they'll facilitate the lending decisions and promote responsible borrowing. So they work like CRB, correct? So that is the job of the um, credit bureau. So the
Okay.
functions of the credit bureau are many. So you just need to know at least the context in which the question has been brought in. So I've talked about four. Let me go through them again. One of the functions of credit bureau is what? Information, collecting credit information. So they'll gather detailed information from lenders and microfinancial institutions. They'll maintain credit records. So they'll maintain an up-to-date record for borrowers. They'll assess the credit worthiness. So these ones will have data to provide credit reports and credit scores. So this is important to know. All right. Any questions at this point? So
Oh,
good
so
question. Mhm.
here where you're referring to the kind of like notes, are you able to share that as well?
Okay, sure.
Mm,
I will.
okay, thank you.
All right. So let's go to question number 12. When interest rates is lower than equilibrium rate of borrowing on labor funds. Okay, when interest rate is lower than equilibrium rate of borrowing on labor funds, then financial system has surplus, deficit, short-term, long-term funds. So this is briefly some uh, economics. Okay, this is some brief economics. What do you think is the answer?
Mm,
B. Okay,
okay.
B is the answer. So why is B the answer? I need to explain using some graphs. So what happens in loanable funds market, the equilibrium rate looks like this. So you know where equilibrium happens? Equilibrium is simply a point where, show some illustration. I hope it doesn't throw you off. See my screen. Able to see my screen?
Yes.
Okay. So what am I trying to say? I'm trying to say here is um, the loanable funds market, the equilibrium interest rate is simply a rate at which the quantity of funds that the borrowers wish to borrow is equal to the quantity of funds that savers are willing to lend. So at this point, the market is cleared, meaning there is no excess demand and there's no excess supply of funds. So mathematically, it is simply where demand is equal to supply, and demand is downsloping of loanable funds, and supply is upsloping. So this is equilibrium. Okay, this is demand, this is supply, this is equilibrium. So what this means is um, at equilibrium, the quantity demanded is equal to quantity supplied. So at this equilibrium, borrowers who are willing to pay the market interest will get funds they need. All the savers willing to lend at this rate will have their funds utilized. So when the interest rate is set below this equilibrium here, what happens? The interest rate is set below this equilibrium here. It's the equilibrium. The following will happen. Number one, borrowing becomes cheaper. Number two, demand for loans will increase because the borrowing is cheap at a lower cost. Number three, supply of funds will fall because people will be scrambling for the low interest funds. So what will happen? There will be a mismatch between the high demand and the low supply. So what will happen? There will be a deficit of loanable funds. So lenders will then ration on those loans or favor certain borrowers and impose some requirements, right? So this therefore will take us back to this scenario. All right.
Okay.
So now the question still goes to say when interest rate is lower than equilibrium borrowing of loanable funds, what will happen in the financial system? So meaning there'll be what? A deficit of funds because there'll be more people, more pressure for those funds. Okay. Which
Okay.
of the following is most likely to um, result in lower interest rates in a nation? Which of the following will most likely result in a lower real interest rate in a nation? Okay, so if that was clear, um, I'll explain the last element, then we can call it a day. So you discovered most of these questions are economic in nature. So you need to really understand the principles for you to appreciate what is being explained in the scenario. Are we together? So it looks easy, but it's more than just that. So some of these things are graphically. In the other section, you may need to illustrate. So the real interest rate, is the difference between the nominal interest rate and inflation. So real interest is actually the cost of borrowing or the return that you get on investment. Real interest is actually determined by supply and demand for loanable funds. So let me show you the equation that we use. Um, Said I was sharing some notes with you. Don't know why I've not been sharing notes. Okay, let me
Mm-hmm.
share this screen before I erase it. Okay. Did I send you the video, yesterday's video?
No.
Send it to you.
Okay.
So what was I saying just now? What was I talking about? The real
I think we're
interest
trying to
rate.
answer. Yeah.
Yeah, so what did I say is the real interest rate? So when talking about real interest rate, we're talking about what? The difference between the nominal interest rate and inflation. So interest rate is actually the real cost of what? Borrowing, or the return on investment adjusted for inflation. So the real interest rate is actually determined by the supply of and the demand for loanable funds in the economy. So what do we mean by supply of funds? This supply of funds will come from the savings from you and I, households and businesses. And the demand for funds will actually come from borrowers who can also be the same households, firms, and government. So when supply of funds increases, relative to demand. So the real interest rate will fall. The opposite, when the demand exceeds the supply, what will happen? The interest rates will rise. That is the norm. So now with these options, you will understand that if there's a tax credit incentive that has been imposed to businesses to invest, they'll reduce this tax burden. All right. So now going to our question here. Our question simply reads, which of the following most likely result in lower real interest rate in the nation? Number one, the nation provides an investment tax credit to new businesses. The citizens of the nation increase their savings for retirement. The nation is experiencing potential political instability. And lastly, but not the least, if the nation's government is borrowing to finance um, projects. Okay, what do you think is the answer there?
I think I
The
missed the
answer,
explanation.
the answer
Yeah,
is B. So if
B.
the citizens'
Mm.
nation increase their savings for retirement, so here the understanding, like how I was trying to explain, is that just to take you back a bit, that the real interest rate is simply what? Real interest rate, I said, is simply the difference between nominal interest rate and inflation. So I
Mm.
explained to say, in the context, the real interest rate is influenced by the supply of demand and loanable funds. So supply of funds comes from the households, the demand for funds comes from the businesses. So when supply exceeds demand, the real interest rates will go down over. But when the demand exceeds supply, the real interest will raise. Is that clear, first of all? So now,
Mm.
what options do we have that are available? So the following options that we have in the um, multiple choice questions, just to explain what we have, is the first one was saying invest investment tax credit to new businesses. So tax will encourage businesses to invest by reducing the tax burden. The effect here will be that there'll be demand for renewable bonds. So that one not correct. Citizens increase savings for retirement. This one is correct. Why? Because there'll be more household savings that will increase the supply for loanable funds. Secondly, with more funds available for lending and borrowing becomes cheaper. So what will this impact? To impact on the real interest rates going down. So this is why B will be considered a correct solution. So we'll end
Okay.
here for tonight from question number 18. Then we'll continue with the others tomorrow. Thank you so much for your time.
Okay. Okay. Just a quick question. So every day will I have to? I called the lady that the number you gave me because I already allocated some time. You requested to say